Welcome everybody to another episode of DeFi Revelations today. We had a extremely exciting conversation today with David, the founder of Superseed. If you are a CDP fan, this episode is definitely for you. Superseed is supercharging the CDP model. And the interesting part is I think they've created unique flywheels built into the layer of the protocol that will allow them to create like the best lending environment for ETH, which is going to be huge, obviously, for their growth and the adoption of Superseed as a chain, which feeds, the other fees that feed into the super collateral that they're building, to borrow against on their model. So we get into everything. We get into David's journey a little bit, into crypto. We really pull back the layer on Superseed and where all of the fees are coming from that they're using to repay the super collateral token, that they're bringing to market. So definitely give it a listen. If you like it, definitely like and subscribe and give us a follow, and we will see you next time. Welcome everybody back for another episode of DeFi Revelations. Really, really excited for this conversation today. Superseed, I think, is building some unique models into its L2. So very, very excited to see you guys, to hear about what you're building. We've got David, the founder of Superseed, with us today. How are you, sir?
Hey, Kirk. I'm great. Super excited about the podcast today.
Yeah, me too. So let's get right into it. Tell me about your personal journey a little bit. How'd you get into crypto? Were you involved in any other projects in crypto before you decided to build Superseed? Give us the story.
Sure. So yeah, my crypto story starts back in 2014, like early 2014 is the first time I actually acquired some BTC. Back then, like a small fraction of a BTC that I mostly wasted trying to trade alts because it was already like the market was heading towards a downturn, but people were still excited. So yeah, that was it. And for for a period of time, I was basically an outsider that was checking what happened every now and a while, like maybe every 2 weeks. But then in 2017, I discovered Ethereum, and I got really fascinated by what was happening then, like all the possibilities. It wasn't only about trading coins anymore. It was about applications, it was about like the whole new fundraising model that ICOs were in a sense providing, and it was a really exciting time. And I started to pay a lot of attention. Had a great year when it came to my investments. And yeah, by the end of the year, I actually quit my job. And ever since then, I'm full time in crypto. Now, for quite a long time, I was mostly an investor and occasionally a trader. I also helped projects by advising them, and yeah, was deeply involved in DeFi. Did some angel investments as well. And basically, only last year I decided to actually start something of my own. I had I had an idea I was sleeping on for like 2 years. I was expecting someone to actually go ahead and build it, and nobody did. So, like after a while, I decided, okay, if nobody is building this, I have to do it. And that was late last year when I started Arcantum Labs, which is the company that initially contributed to Superseed. Um, and yeah, ever since then, we're working on Superseed, and we're getting really close to our mainnet launch in probably like a few weeks.
Nice, nice. Yeah, really, really excited to get into Superseed. I think there's a lot going on, obviously, in the L1 and the L2 space from the infrastructure side. I think everybody's focused on scaling solutions and general purpose roll ups, X, Y, and Z. And I think what stood out for me when I first heard about Superseed was just that you guys have a very specific thing that you're trying to achieve. at least at first, right? And I really, really like that when I see that about teams, because if you have a specific focus, you can really, really perfect, maybe that primitive or that application. And then obviously branch out to other things, right? But I always think businesses in general get very caught up in trying to do everything all at once. And Superseed obviously is very focused on a certain thing. So I guess get into Superseed then. I guess give us the elevator pitch. What is Superseed? What are you trying to solve? How does it work? Let's get into that a little bit.
Sure. We call Superseed the first blockchain that repays your debt. And what do we mean by that? Well, Superseed is an Ethereum L2, but we've built Superseed from the start with the idea of a lending protocol on top of the chain, where we allow people to borrow against our governance token. And as long as they maintain certain safety criteria, they don't pay interest on those loans, and the fees that are generated across our platform, and we have different sources of fees for that, all go in the same direction, which is to repay the loans of those who use our token as collateral in this lending protocol. We call that a super collateral. So what's a super collateral? Basically a crypto asset that has that fluctuates in price, right? That can go up or down, that you can borrow against. You can borrow against. You can borrow a stable coin against it, and importantly, you don't have to repay your loan because there's some sort of source of fees that is used to repay that loan for you. So that's what we call a super collateral. And with Superseed, we try to find as many sources of fees to use for this purpose. And initially, we have three major sources of fees that we want to use to repay the loans of super collateral borrowers. And these sources of fees are the following. First, because we're on L2, we generate sequencer revenue. So every time people transact on our chain, they pay a small fee. And of course, there are some costs when it comes to paying Ethereum for that. But the profits that are generated from running the sequencer, they all go in the same direction, which is to repay the loans of super collateral borrowers. So people who borrow against the token and maintain certain safety requirements see their loans automatically repaid over time from network activity. So this is the first source of fees that we are using for this purpose. There are two more sources of fees. The second one being interest that's paid by borrowers in the CDP, so in the lending protocol, who use a different type of collateral. So in the CDP, you can use our token, so the super collateral, but you can also use ETH to borrow, or other tokens that fit the criteria when it comes to liquidity and security and so forth. So if you borrow, let's say, against ETH, you will pay interest on your loan, and that interest we're also using to repay the loans of super collateral borrowers. So if you think about a lending protocol like MakerDAO, they generate a ton of revenue, right? It's quite substantial, one of the highest in crypto. But what they do with those fees and what they do with interest, the interest they collect, is very different. They do buybacks and burn of their token. So they gradually buy Maker tokens and remove them out of circulation. And we have a saying at Superseed: burn debt, not capital. So I like this saying: burn debt, not capital. We believe it's hugely capital inefficient to use revenue or profits or fees to do buyback and burn for the native token. Rather, we would prefer to use that to repay loans for super collateral borrowers. We believe it's way more capital efficient, and not just that, but it allows people to, it has many benefits, one of which is it potentially allows people to borrow today, let's say, a few years worth of yield. And if they maintain the position, they basically see that that loan repaid over time. So instead of having to wait a few years to capture the yield, you capture it upfront, and you only have to maintain that position. So because there's something called time value of money, it's more capital efficient to do it this way. And this is the second source of fees, revenue from interest paid by borrowers who use a different type of collateral in the CDP. And we have a third one, which is something we invented called proof of repayment. Now, what's proof of repayment and why did we call it this way? Well, it's inspired by proof of work and proof of stake. And we see proof of work and proof of stake as a programmatic way of rewarding participation in the network. For example, with proof of work, if you're a participant in proof of work, what you are doing is you're securing the Bitcoin blockchain, right? You're responsible for the security of the chain, which is why you're getting rewarded, right? New Bitcoin get minted every block, and they get distributed to those who secure the chain. So it's a programmatic way of rewarding behavior, let's call it, right? At proof of stake, it's the exact same thing, right? If you stake your ETH, for example, on Ethereum, you're securing the chain. You're a participant in the security, and this is why you're getting rewarded in a programmatic fashion. Now, with L2s, there's a huge advantage here in terms of security, because you're not responsible as an L2, you're not responsible for your own security. You get that for free almost from Ethereum. So on L2 does not have stakers, validators securing the chain. It depends on Ethereum for security. So you could develop as an L2 an alternative way of rewarding behavior in a programmatic fashion. And this is what we are doing with proof of repayment, which is we're using newly minted tokens to reward certain behavior. And what we care about with Superseed is repaying the loans of super collateral borrowers. So how does proof of repayment work? Well, we have 2% inflation, just like other L2s. Optimism, Arbitrum, they all have 2% inflation. This is like an accepted rate of inflation. And the way those newly minted tokens get distributed is via daily auctions. So the 2% per year gets split up in daily auctions. And every single day, people can come and participate in that auction by committing a certain amount of stable that they want, right? Whoever wins the auction for that particular day gets the reward, and whatever they committed, so the stables that they committed, go towards repaying the loans of super collateral borrowers. So this is how it works. It's a way of using those rewards in a way that benefits super collateral borrowers. So these three are our major sources of fees that we plan to have. The advantage here is that they aren't particularly correlated to each other. They can go in different directions. So sequencer revenue depends on whatever happened that day on the chain. If there's like some sort of people are minting NFTs or doing some sort of whatever, right? They might do in a particular day that can go up in value, and sequencer revenue has strong fluctuations in terms of how much they can be in total. And then like interest paid by borrowers with a different type of collateral is more like about assets under management. So how much people are borrowing, it's quite constant. It barely fluctuates. It depends on like how much people are borrowing and interest rate. So it's a lot more stable. And proof of repayment, the fun part about proof of repayment is that it scales with the price of the token, just like security for Bitcoin scales with the price of Bitcoin. If the price of Bitcoin goes up, the security of the chain also goes up because the reward grows with price. The same thing with Ethereum. That's true with proof of repayment as well. So if the price of the super collateral goes up in value, the amount that gets generated in fees from proof of repayment also goes up. So all these three are not particularly correlated, but they all go in the same direction, and that direction is repaying the loans of super collateral borrowers. So this is, in short, what Superseed is all about.
Pair Protocol is the first and only trading platform for narrative trading. Their technology unlocks the ability for anyone to pair trade. For example, if you think ETH will outperform Cardano, you can long ETH ADA in one click with leverage. Or perhaps you think Pepe will continue to outperform Doge. You can long Pepe Doge. Again, all in one transaction. The combinations are endless. Learn more at beta.pair.garden. Gotcha. Yeah, I think it was a smart design choice to incorporate like different revenue like sources, right? Or different fee sources to repay that super collateral debt because, each of them has its own contingencies, right? Or its own reliabilities. And I want to get into each one really quick if you don't mind. I want to talk about them really quick. So the first thing that comes to mind when we talk about like the sequencer revenue, a couple questions there. Number one is obviously recently you guys have announced that you're going to be joining, the super chain, right? The Optimism
Yes.
super chain. Along with that, right? Part of that is you have to pledge, I think it's 15% of the sequencer revenue to the super chain, right? So, it takes
profits,
a cut out of the fees, right? That might be going to repay these debts. So in order to counteract that, obviously, and make sure that there's a lot of fees coming from that particular source, there's got to be a good amount of activity on chain, on Superseed itself. So, like, how are you guys thinking about like attracting builders and attracting apps to come build on Superseed? Is there a synergistic relationship between like the CDP and the super collateral, and maybe like making that an attractive form or attractive building block for builders to come to Superseed? Because in my mind, you probably want to have a pretty vibrant ecosystem on Superseed that's, submitting transactions, minting NFTs, trading, X, Y, and Z. So maybe talk about that a little bit. I know you guys have some pre-launch partners you already announced, but how are you guys thinking about that? And like, what's the main advantage of building on Superseed as a builder?
Okay, so I would see those as two separate questions. Why we chose the L2 design versus like being an app on another chain? Because in a way, the question is related to that as well. And I think even if the fees themselves like sequencer revenue might not be the highest from all the sources of fees, we believe it's probably going to be one of the lowest overall, just because today sequencer revenue does for many chains is below 6 figures per day, right? So it's not extremely high. Maybe Base has more than that, but most chains, because they cut their fees a lot after EIP 4844, capture 5 figures per day in terms of fees. So it's not substantial. But for us, because we're building a few primitives that other apps will build on top, it still makes a lot of sense to be capturing some of that activity. So if you think about the stablecoin, right? Because people are borrowing our stablecoin. If we were to have deployed our CDP on whatever chain. Like all that activity surrounding the stablecoin, all those payments, all those integrations would have meant the fees themselves related to activity um, when it comes to our stablecoin would have gone to that particular chain rather than um, flow to us. So we consider we consider it more important to be able to capture some of that back and give it to super collateral borrowers than to I don't know give it to Arbitrum or someone else. And the second part is when it comes to attracting liquidity and integrations. Well, today there are quite a few different EVM chains, and as an app builder, you have to either decide to go on every single one of them or most of them, which is quite bad in many ways, or you want to attract your users or your potential users to come to your chain. And we believe that interop is improving at a really fast pace. So it will be super easy for people to come to your chain, but it's not going to be as easy for an app to deploy on every chain and maintain liquidity or give incentives on 20 different chains. So for a CDP, especially, it would not have made much sense to go that route. We rather bring the users that we want to have to our own chain. And I do believe we're pioneering in a way this approach because we're still seeing most applications right now trying to deploy on all those chains, but it's becoming harder and harder. And even now with Uni, we've seen that they are choosing to actually okay, instead of deploying to another 20 chains, maybe let's have our own chain and try to bring most of the activity here because it's going to be super easy to bring the users from all those chains to us rather than chase every new chain. So that's how we see it as well. And of course, even for those that build on top of our primitive, on top of super collateral, on top of our stablecoin and so forth, it still makes a lot of sense for the apps that want to be in our ecosystem to integrate with us on our chain rather than having to then chase us everywhere we go, right? So even if it's a single integration, if you were to be on 20 chains, we would have to bring that particular app that integrates with us on all those 20 other chains rather than bring them to us. And this is how we view it. We also are quite focused in terms of what we want to have on our chain. We are a general purpose L2 in terms of the stack, but we're not chasing all the rabbits, right? We're not chasing every single app. We're really focused on DeFi and specifically DeFi that interacts with our own CDP. So things that can integrate with us down the road and things that are necessarily DeFi infrastructure for us to be able to exist in the first place.
Gotcha. Yeah, I think that makes sense. And really, I guess this ties into the next, source of revenue, right? Which is like the interest being paid by non-super collateral borrowers. So, obviously the assumption there is that there will be demand for people to come to Superseed CDP and borrow these other assets. You mentioned ETH. I don't know, obviously you probably have more assets over time, but what do you think is going to be like the selling point for like ETH holders to want or I guess for users to want to come and borrow maybe against their ETH or against other assets in your CDP versus maybe other CDPs out there. Because obviously you answer that question and then you answer the question of how do I get interest payments coming in to repay super collateral. But maybe talk about that a little bit. Like how are you guys
Yeah,
thinking about
yeah.
making it super attractive?
Yeah, this is a great question. One part of our design, and this is really important, is how the fees themselves flow in the system. And we have something that we call repayment vaults. So as we capture fees, they don't automatically and directly go towards repaying loans, Rather, they first go into something that we call repayment vault. So every dollar that goes into a repayment vault gets gradually over time deployed towards pro rata repaying loans. And this is really, really important because repayment vaults actually act as free token sinks for the stablecoin. So one of the challenges that CDPs have when it comes to scaling is that oftentimes they might have to charge more in interest to be able to maintain the peg, right? Because what often happens if you don't, especially early on, but even later on, is that oftentimes people who borrow a stable coin versus a crypto asset don't just hold that stable coin after. They might want to do something with it, like go long the market, like buy more ETH or do something with it, or even swap it to another stable coin. So that's downward pressure on the stable coin. And the way like other protocols have solved this issue in the past, for example, like Maker, is that when you see DPEGs or when you see downward pressure on the stablecoin, what you have to do is to increase the interest rate for people who borrow, which creates like an incentive for them to repay some of their loans, to not get liquidated, and counteract the selling pressure. And another thing that they have done is, for example, Maker has the DAI savings rate, where like if you acquire DAI on the market and place it into what is basically a stablecoin sync, you get paid to do that, right? You see your DAI stash increase over time. But those have costs, right? The DAI savings rate has a cost. Increasing borrowing costs is also like preventing you from scaling. People won't borrow as much if they have to pay more and more, like exponentially more. If you pay 15%, you might not want to borrow at all because you have to beat that in terms of returns if you want to not end up getting liquidated. Now, because of how repayment works in our system, many of the fees that we capture are not in our stablecoin itself, right? For example, sequencer revenue. We capture sequencer revenue in ETH. And in order for repayment to happen, two things are happening. First of all, there's a swap happening between ETH and our stablecoin. So there's constant demand for the stablecoin as people transact. People who transact on chain, they actually bid the stablecoin itself, right? They constantly, every block, they bid the stablecoin, and then they also place it into stablecoin sync. Like we get the same thing as the DAI savings rate without having to pay people to place their stablecoin there, right? Because of how repayment vaults work, and we can use the repayment vaults as a way to either accelerate repayment and basically shrink the amount that sits in a repayment vault, or decelerate it, right? And if we decelerate it, more and more of the supply, just because of automatic repayment, gets removed from circulation all the time and placed there in the repayment vault, thus counteracting the effects of downward pressure on the stablecoin. And this is really important because fundamentally, from first principles, by having this design, we can offer cheaper borrowing rates for people who borrow against ETH as well, right? Because we don't have to work as hard to maintain the peg. the system itself works to maintain the peg. So this is really important. We can attract borrowing by offering cheaper rates, and you get like a stable coin that's sufficiently like maintains its peg without issues. So yeah, this is the main thing here. We can offer cheaper rates in theory just because of how the system works.
Yeah, that makes a lot of sense. Yeah, very very interesting. So it's kind of like you have a built-in flywheel, for the stablecoin, right? All kind of at the protocol level. Is very very interesting. Because that was going to be my next question is like how do you maintain the peg? But I think obviously you just answered that. That's unique. Yeah, that's pretty cool. And the other thing I thought of was too was we'll get to the auctions here in a minute, but if I can borrow the CDP, can I also participate in the auctions with the Superseed stablecoin? Like, can I bid on more of the token with the stablecoin?
Yes. That's the
Gotcha.
point. But of course, others might do it as an arb, right? They might say, okay, if there's like a difference, I can get a better price versus the market price. I might decide to arb that small difference between what I can buy the tokens in on the market versus the auction. Now, it's also important to note that it also causes demand for the stablecoin, like the auction itself, right? Because in order to participate in the auction, you're also bidding the stablecoin itself to be able to commit it for repayment. So that's another aspect. So many of our sources of fees actually mean that someone is bidding the stablecoin all the time, helping the peg and helping us scale much better than others have done in the past, where they might have to issue whatever inflationary rewards for people to not sell the stable coin, like hold it in whatever in a contract for a long time, just so it can function. So we don't have the same issue as them, and yeah, I'm quite excited to see how large the whole thing can get.
Yeah, that's really interesting because I mean, if you can create that scenario, I mean, it almost makes no sense not to borrow on Superseed, right? versus other avenues out there, right? Because it's going to be hard for I think other models to compete with those rates, just because they don't have that built-in mechanism,
Mhm, mhm.
at the protocol level, right? And all of these built-in sinks, they have to look elsewhere for those sinks, right? Whether it's building secondary liquidity on Curve, right? Or we've seen all of
Mhm,
these
mhm.
models, right, on L1 and all these L2s, but building those secondary markets costs. There's cost to that, and there's
Yeah.
scalability issues to that, right? So there's limitations to
Mhm,
that,
mhm.
but it's almost like a self-sustaining flywheel, which is really really interesting. No, cool. Yeah, I think that answers the primary questions I had about the revenue sources and the model in general. So, we talked about a little bit about you guys are going to be focused on like deep DeFi, building a DeFi ecosystem, on Superseed. What are some of the partners that you guys have been able to convince to come build on Superseed day one, or bring their apps over or build new primitives? Maybe talk about that a little bit from a partnership standpoint.
Sure. So we have a bunch of infra partners to make sure that apps can be built on top of Superseed, bridges, oracles, and so forth. But in terms of applications, we were focusing on DeFi and LP DeFi. So we're onboarding partners like Strike, Orange Finance, Margin Zero, um, and Dolomite, and a few others. We have dexes as well that are going to deploy day one. So we want to basically achieve the core DeFi infrastructure as soon as possible, like to have all those core DeFi primitives on chain from day one. in order to be able to onboard all the others who are building on top of them. Like, for example, in order for something like margin zero to exist on Superseed, well, we need concentrated liquidity, a DEX with concentrated liquidity. We need Strike to deploy, and only afterwards can something like margin zero function. Margin zero is an upcoming product that offers non-liquidatable perps by also using options to protect from liquidation. It's a super fascinating product. Perps have gone have a lot of product market fit in crypto. Options less so, but if you combine them and you don't get liquidated when there are extreme price movements, but you also get the leverage from perps, it's amazing. And one of the first products to be on Superseed will be like the combination of these three. And I really am excited about Legos like that you can combine.
Vertex is a lightning-fast order book DEX offering spot, perpetuals, and money markets with unified cross-margin and a vertically integrated product suite. With Vertex Edge, users can tap into the power of shared cross-chain order book liquidity across Arbitrum, Blast, and Mantle, while earning trading rewards in VRTX, ARB, and MNT. Traders can access over 50 spot and perpetual markets alongside the GMCI 30 and meme indices, with low-fee trading and capital efficiency, all while preserving self-custody and on-chain settlement. Learn more at vertexprotocol.com.
And
yeah, I agree. And keep going.
Yeah, hopefully down the road we can get as many as possible to actually integrate with our own primitives that we're building, like super collateral, proof of repayment. Getting all those integrated with other apps is like our long-term vision.
Yeah, it makes it really interesting, I think, for builders from this aspect. Like if you have a CDP that is very, very cheap to borrow from, right? That's liquidity that can enter into these apps, right? Like if you're borrowing cheap from from Superseed, I'm borrowing the Superseed stablecoin at 0% or very, very cheap. And then I can go provide liquidity into these, these primitives, these options protocols, these DEXs, these LP management services, et cetera. You're obviously capturing a larger and larger spread, right? So I think it becomes very, very attractive for DeFi to exist on Superseed because, again, going back to the core primitive of you might have the cheapest borrowing venue in all of the market, right, because of the mechanisms. So it's just an interesting. I really like how everything kind of can build together off of this like base layer of the CDP model. I'm sure you see it the similar way, but just kind of occurred to me.
Yeah,
it's all built in.
Yeah, because I was mentioning at first, right? We've seen certain components of the whole system work in the past where they worked as individual units, but I've not seen them combined in a product, right? And if you actually combine them, it makes the whole thing much better, right? We've had CDPs before. We've had even self-repaying loans for not necessarily for if you borrow against governance tokens or things like that, but we had stuff like that before where I don't know you give your stable coin to a protocol, they farm with it and give you a loan.
Yeah, I think Alchemix
have done that. Yeah. Although it's quite different because you cannot use like the Alchemix token as collateral. You're
right.
It's a different system, but the idea itself existed in the past of self-repaying loans. If you combine everything in a single product, it can be a better product than just taking individual units and have them as products.
Yeah, I think that makes a lot of sense. And I guess, and I don't know if this is possible or not. My thought goes to, I don't think anybody's been able to crack like under collateralized lending, in DeFi. Like, do you see any kind of like roads in to like solve that problem too with Superseed, where you can open up, maybe under collateralized lending because you do have this repayment mechanism, or like maybe talk about that a little bit, because I'm curious, like what kind of LTVs you can get on the various assets as well.
Okay, not necessarily under collateralized lending, but you can get something else, which is also really, really exciting. And this is something that it won't happen in the first version of Superseed or our CDP, but we're thinking of uh, uh, eventually adding that to our protocol, which is right now it's really tricky to add assets in a CDP because the worst asset you have can potentially, if you don't have guardrails in place, like limits in terms of borrowing and stuff like that, it can mess up the entire system. Like if it's easy to manipulate the price of one asset, someone could borrow a ton against that asset, even though like the price itself wasn't truly going up, it just went up for a very short while and whatever. Like there are many scenarios like that, and it's you don't really see many tokens get added into CDPs because of that. And now one advantage that we could have here is that because of repayment vaults, we could potentially allow tokens that today would not be considered sufficiently good collateral to be added in a CDP to be added, and to limit the amount of debt that can be issued against that particular token to what exists in the repayment vault for that specific asset. So let's say we offer this primitive of a super collateral to other projects. There's like a project that generates revenue, like a DEX, for example. It generates a lot of revenue, but nobody wants to use it as a, like no CDP wants to add it as collateral. Now, as long as they have more more stable in their own repayment vault, let's say they have their own repayment vault, and the amount of debt that gets issued against that token is lower than that, in theory, the protocol itself can never get into the situation of having bad debt from that asset. So even if the asset goes to zero or things like that, it doesn't matter. It doesn't matter for the protocol because the debt itself never goes above what's in the repayment vault, and if it cannot go above that, there's always enough to cover like bad debt. So no bad debt can happen in that specific scenario. Now, what happens to the risk itself is that it shifts from the protocol to other people who are borrowing against that asset because they like if there's like an oracle attack or whatever, they may get like liquidated or something, or like if that particular token happens something to the token, yeah, it can be a risk there. It shifts the risk from the CDP to other borrowers using that asset as collateral. But the protocol itself could potentially add uh, assets that aren't as great today in terms of being used as collateral. And if we offer this primitive to other projects, basically we can have like a fourth source of fees, right? Where we offer that as a service in exchange for some fees. So if this becomes sufficiently successful as a way of distributing, like if the super collateral, um, let's call it, model of a token becomes sufficiently successful and a lot of projects want their token to be a super collateral, then we actually capture a lot of the fees that are generated across crypto for our CDP. Because one way of seeing what super collateral is The way I usually explain it is the following. Back in 2017, applications that were issuing tokens, the use case of the token was supposed to be payment inside the app. So back then, when a new project was launching and issuing a token, the use case for the token was you were supposed to use it to pay inside the app. And it failed, of course. Nobody is building utility tokens like that anymore. The new or the current version of what a token is, like a good one, is a governance token. And governance token are an improvement over the last model because you now have the possibility to govern the protocol in certain ways, like maybe vote on upgrades, vote on how the treasury gets used, things like that. And with the best bunch of governance tokens, if there are fees that are generated by that project, there's some sort of um, there's some sort of money accrual, accrual to token holders. Either there's buyback and burns that are really popular these days. We consider them not capital efficient, but that's one model, or like V economics where you lock and then you get some of the fees that way. So it's an improvement, but we consider super collateral tokens as the next iteration. Like this is going to be the future of what a token can be, because it allows you to do something that I believe most of us want to have in crypto. When we hold a token, we that has upside that can go up or down in value. We actually want to be long, right? We want to be long-term holders usually. That's why we acquire certain tokens. We want to benefit from price appreciation. At the same time, we also want to sell. We don't want to just die with those tokens in our wallet. We kind of also want to be able to um, benefit from that price appreciation. So we have these two like internal wolves: the one who wants to hold, the one who wants to sell, and they constantly fight with each other. And with a super collateral token, you can get the best of both worlds because you can remain long indefinitely, borrow against your position, and have access to liquidity, but you don't have to repay that loan because gradually over time, network fees go towards repaying your loan. And for many people in crypto, I believe this is going to be a major unlock and like hugely beneficial. It solves the problem that basically everyone who's on chain in crypto kind of has, and not just on chain, but like mostly for on chain people, this is like going to be a major thing, and it's like a next iteration of what a token could potentially do in crypto.
Yeah, no, it's exciting, man. I'm excited to see it in the wild. And I guess moving towards that, what is coming up next for Superseed? Like, what does the timeline look like for mainnet? I know you have a public sale coming up for the token as well. Can you touch on those two things a little bit on those two milestones?
Sure. Yeah, the Superseed Foundation will have a token sale in the following weeks. So I would advise people to check our website to find out more about that. It's going to be on the Superseed website. Details around that. Basically, Superseed believes that the current model that many L2s have followed is not sustainable, where many of them will wait a very long time until they launch the token and basically launch with a low float, high FTV, and are unable to build any community. We or Superseed itself does not believe in that model. We believe much more grassroots model, and yeah, if people want to check that out, the sale is coming, and once that has concluded, mainnet will launch at the same time as TG is happening. So um, sometime next month, mainnet will be live, and people will be able to use Superseed.
Awesome. It's coming up close then. It's right on the horizon. So very, very excited to see how this plays out. Yeah, thanks for coming on, David. Really appreciate your time digging into this a little bit. I learned a lot. I think you validated a lot of the questions that I had about the model, and I'm excited to see it. I mean, it's going to be. I think it could be, a game-changing primitive for DeFi, and for trying to scale, adoption for. I think not only for the Superseed, super collateral, but as you mentioned, if you guys can get to the point where you can expand, and offer this to other, tokens, out there. I think that unlocks even an additional layer of buying pressure, ultimately for DeFi tokens, because I think the market has said multiple times, there's infinite demand for leverage, there's infinite demand for being long, but you have to have the right, situation to be able to enable those levers, right? So yeah, thanks for coming on, David. Any closing thoughts
Thanks
before
for
we wrap
having
up?
me. It was a really good conversation. I love it when we can go into details like that. It doesn't always happen. And yeah, would advise people to check our website, follow us on Twitter, and yeah, um, be prepared for what's coming next with Superseed.
Awesome. Yep, well, you heard it here first, folks. Yeah, check out the notes. On the episode, we'll definitely have links to the Superseed socials, and kind of stay tuned to Revelo Intel as well. We're going to be coming out with a lot of content on Superseed that you can use to kind of simplify your journey through the due diligence process for the platform. So, thanks everybody, and we'll see you next time on the next episode of DeFi Revelations.